So this is kind of the fun part of the show. Now we're gonna have a few panels here to round out the night or round out the day. First of all, thanks everybody for being here. I mean, this is great. I hope everyone's getting things that will help you in your trading journey as you go down that path that we've all gone down here on this stage, and just like many of you. I want to say personally, I'm filled with gratitude to be here on the stage in front of all of you, to be able to talk about trading and the things that are important to me, and to share the stage with three gentlemen who I'm proud to call my friends, but also three guys that have been instrumental in me, in my career as I've progressed. Of the three, Brian is the one I met first and became aware of first when I used to work at Stocktwits. I was a director of community at Stocktwits for a long time. And my name is Sean McLaughlin. Sorry, David. I thought everybody knew me. No. My name is Sean McLaughlin. I'm from Chicago Sean on Twitter, if you guys follow me on Twitter. Yeah, happy to meet you. So what was I saying? Okay, so Brian, when I first started at Stocktwits, I think on day one, I was told that Brian Shannon is somebody I should know. I should get to know. He was our star member of our community. So fast forward, many years later, I moved out to Colorado. I live in Boulder, Colorado now. Brian lives in Denver. So I've had the good fortune of being able to hang out with Brian and call him a friend, and he's been instrumental just watching him on his blog and on Twitter. I've read his book. He's just one of those smart guys that is, if you're a technical analyst, Brian's a guy you got to follow. You just have to. He's one of the smartest guys out there. JC soon after, I was told that he's an all-star, and he's got a blog called All-Star Charts. I'm like, who's this asshole? But he lived up to it. I mean, he was immediately, when we launched Stocktwits, he was immediately one of the best and hardest working technical analysts out there that was just sharing great content all the time. Big picture stuff, small picture stuff, and as he said in his presentation, you got to put the work in, and he was putting the work in more than anybody in our community, I thought. So obviously I've gotten to know him over the years, and then of course Dr. Brett, who needs no introduction. If you're a trader, if you've been a trader at all for over the last 10 years and been active in any way on social media, you've come across his writings, his blog posts. I mean, his blog post is like one of the must-read venues. I mean, I remember, Brett, and I've told you this before, but there was a period of time a number of years ago where you stopped blogging, and that was a dark period for me, because I read your blog. I read your blog every day, and it was a part of my routine every day. And it hurt me when you stopped blogging.
It hurt me too. When you work full time in a hedge fund, the compliance folks don't like you writing stuff about markets, and so that's why I had to stop.
So I was very happy when I learned that you were coming back and you were going to be blogging some more. And
right.
And to everyone's benefit, if you've never read Dr. Brett's blog, traderfeed.blogspot, you're so old school. Traderfeed.blogspot.com. It's a must read. And of course, he's an author. I've read all his books. I'm sure many of you have read his books too. Great resources. Okay, so anyway, so what are we doing here on this panel? What we are planning on doing here is we want to make ourselves available to you, the audience, to discuss challenges that we all face as traders. And I'm hoping that the three fine gentlemen here can offer some great perspectives to challenges that you might be facing. So we don't really have an agenda up here. We want to take questions from you guys and take that where it goes, and hopefully it's constructive and beneficial to all of us. So if there's anyone who's sitting on a question right now that wants to tackle right in, let's go. Don't be shy. Anybody. All right, there we go.
Could you talk a little bit more about paralysis by analysis and how you overcome that?
Paralysis. Sorry, I have to repeat it for the people who are live streaming at home. So your question is about paralysis from overanalysis, correct? Okay. Well, let's start with JC because he looks at 18,000 charts every hour or something. So you might be at the risk of overanalysis more than anybody here. So how do you deal with that?
There's no question. So I'm not an oscillator junkie. We all know that guy that's got like 18 indicators: MACD histogram, stochastics, fast stochastics, RSI. whatever indicator they also built, right? And it's like there's so many colors and lines. What are you going to do? Wait for all of them to, to say bye? It's not going to happen. So I keep it simple, stupid. I'm an RSI guy, 14-period RSI. So I use one momentum indicator. I use no or very little moving averages. I use a 200-day moving average in a similar way that Paul Tudor Jones, so I hear. He doesn't tell me anything or call me or know who I am. But he uses a 200-day moving average essentially to help identify the primary trend. So I really do the same thing. And I use it less and less with every day. So I almost don't even use moving averages. So as you see in a lot of my charts, are very simple. Is it going up or is it going down? And the way that I do look at a zillion charts is more to come up with a weight of the evidence conclusion, not because they're all different indicators. So my charts are very clean. That's how I avoid the paralysis by analysis, right?
I think that most people start out early looking for the magic oscillator indicator, and it's just natural curiosity to try to find the one that suits you. So you can get bogged down in complexity, and I think that most people who are still around trading a couple years after that initial break-in period find that their charts do become much more simple, that it's price, it's volume, it's maybe some moving averages, but it really doesn't get very complicated, and you have to do that yourself. You have to dismiss the fast stochastics, the slow, whatever it is, you have to identify it, look at it, and satisfy your curiosity and see what works for you.
Very good, gentlemen. Paralysis by analysis. There's an old saying, never let the perfect become the enemy of the good. And what happens when we are paralyzed with analysis is that we're seeking that perfection, like you're saying, Brian, that out of anxiety, out of what's called performance anxiety, we're trying to get it just right. And in so doing, we become paralyzed. And so a great exercise to overcome that kind of performance anxiety is to actually do visualization work where you are imagining vividly, visualizing, feeling, being wrong. Not visualizing best case scenarios, visualizing getting stopped out. Because if you can keep yourself calm and focused while you're visualizing a trade that doesn't work, which happens to all of us except JC, then
You know that ain't true.
yeah, right? But if we can visualize and keep ourselves calm and focused when we imagine a trade going against us, there's no performance fear. We've accepted that worst case scenario, and we can move forward without the perfect being the enemy of the good.
Great.
I have something to add. I don't think, to your point, and I was surprised, yeah, you got it right, you got to pull the trigger at some point, but there's also nothing wrong with being really patient, right? As I say, there are no called strikes on Wall Street. You could stand there at the plate and watch pitch by pitch go by until it's your perfect pitch. So, we don't need to, go crazy trying to avoid that paralysis by analysis either, right? So there's two extremes. You want to avoid both, right?
You can hold on to that. I just remembered there was a question that came in on our live stream for people who are live streaming it. The question was, when markets change, like markets have drastically changed in the last couple of weeks, whether you're ready for it or not, depending on who you are, the question was, when the markets change and I'm not ready for it, I didn't have a game plan for it, and this might be a softball question to you guys, but what's the best step to take when all of a sudden everything that I knew that works in this environment all of a sudden no longer works? And I'm flustered and I'm scared or whatever. What do I do next?
But I think that's the problem, is that you didn't have a plan.
Right.
Because if you're asking yourself, oh, what should I do now? What are you doing? What was your plan, right? So and Dr. S can speak on this behalf, we revert to our kind of cognitive behaviors when our stress levels are the most elevated, right? And when our stress level is elevated, when there's money involved, right? So we make stupid decisions because our stress levels are elevated when the money is involved. So if you predetermine what your behavior is going to be so that you don't put yourself in a position, allow yourself to be in a position to do something stupid, and you outline what you're going to do prior to that, and what he was saying, visualize being wrong. And are you going to be able to live with that? Like, is that, so we always assume we're wrong. And then if we're right sometimes, we'll take it.
Perfect. Yeah, I've said for years, people have talked about this rally, that it's been going on too long, and it's going to end badly. It's going to end badly. Well, it only ends badly if you don't have a plan, and that's what stops are for. They're your friend. Outline in advance what you're going to do if that happens, and be able to accept it the way by visualizing it.
Very good. I have found, and I'll speak just to my own trading, I've found that some of the best trades have come when a good, planned, well-researched trade does not work out. And I'll say to myself, that should have worked. If the trend was continuing, that trade should have been a winner. That losing trade is information. The market's not doing what it should do. Now, what should it do? It should carry on the way it's been carrying on, but it's not. And that gives you an opportunity to take that trade. What do you do with it? Flip it the other way. And some of my best trades have been accepting the losing trade, taking it as information that perhaps the market has changed.
Mm-hmm. Dr. Brett, you reminded me of something. Back in the summer of 2015, I had you on my podcast, and you said something to me that it was obvious in hindsight, but it shook me, wow, that was really insightful. And you said that it's in pop psychology culture, whatever you want to call it, on Twitter and in social media, everyone talks about traders when things aren't going right. You gotta study your losers, and you gotta figure out what you're doing wrong. And you said, you used some colorful language, I won't repeat it here, but you said that is stupid. What you need to do is focus on the things you're doing right and do more of that. Forget about the losers. If the losers are important, there's lessons there, yes, but let's put more of your energy on the stuff that's working and do more of that. I don't know if you remember that conversation.
I do recall that conversation, and it's really, really important. You have some winning trades, you have some losing trades. Your winning trades very often will teach you your strengths, your best practices. And so, for instance, when I will meet with the traders at Mike's shop, SMB, we go over a monthly review and we focus on what they've done right. Even if they're flat on the month, or maybe they're down somewhat on the month, but what worked for you? What setups worked? What types of names were you in? And that tells you something about the markets and what's paying off, but it tells you something about your own strengths.
Right. I saw a question back there. John.
Yes, with the volatile markets in the current state, just wondering, you gentlemen, are you currently, whether long or short, are you looking more for day trades or swing trades or long-term trades? What kind are you personally looking for?
If I can take that first, Sean.
Yep.
So the question, just to repeat it for people who aren't here, with current market volatility, are you adjusting your time frame, basically? And I think that, for me personally, there's two ways to go with the current trend, which is smaller share size, especially if you're not used to that volatility or you don't have the skill set to trade on a shorter term time frame. My preferred time frame is always a swing trade. I like to be able to hold a winner a few days, maybe scale some out, but the action of the last 2 weeks basically has told me that some of the short swings have worked, and hold on to those, but they can evaporate super quickly. So when it comes down to trading a bounce, I have zero confidence in holding overnight, so they almost have to become day trades.
I have something to add too, unless you want to go next. So what I've done with my trading to address the change of the market and the new direction, I mean, we could argue whether we're heading into a bear market or not. I don't know. But I tend to agree with JC that it feels like we're in a corrective market here, at least in a sideways chop for a while. And I have found that I primarily do options trading. I also swing trade stocks, but I'm not doing many swing trades right now because I prefer an up-moving market for stock swing trades. But with my options trading, in a market like this, I'm wanting to put on defined risk trades because, it's a very volatile market. Things are moving. I don't want to have any undefined risk. And I find in a bearish tape or a corrective tape, you have to be much more aggressive taking profits, be quick to take your profits. And if you've got defined risk on, be more patient if a trade's not going your way. Look, if you put on defined risk and you've sized your position properly, you shouldn't be scared if it's going against you because you already know you've already accepted the loss, so to speak. But you have to be much more aggressive in taking your winners off the table because they can quickly reverse in this type of environment, which kind of goes against what we've all been hit over the head with for years. You got to cut your losers short and let your winners ride. You got to give them room to move. It's kind of the opposite mindset in this type of environment, at least by my perspective. You guys can disagree with me, and people do. That's what makes a market, but that's how I've been addressing it, John.
I think it's important to kind of identify what type of market environment we're in, right? I'm lucky that I lived in New York for a long time, and I've seen some of the best technical analysts in the world multiple times give presentations, guys like Jeff DeGraff and stuff like that. And the first thing they do is identify what type of regime the market is in, and based on that, there are going to be certain strategies to employ versus others in other types of regimes. So, for example, if we are indeed correct, whether or not, volatility is elevated. So because volatility is elevated, Sean is the options expert, but we want to be financing our options trades versus before when volatility was super low and premiums are super cheap. You would think a stock's going to go up, call it a day, just buy a call option and shut up. You don't need to do anything. But now that volatility is more expensive, you want to be selling something to help finance that, correct? Wouldn't you agree?
Yeah, absolutely.
So that's one thing. And then also identifying the way that the market behaves in this particular regime versus the other. So like in a lower volatility regime, we'd get 50-point Dow days, 80-point Dow days at most, right? So now, you want to take the VIX, divide by 16, and that's the average percentage move that you're going to get on a day-to-day basis. So, right? So if the VIX is at 32, you're going to expect 500-point Dow swings a day, right? That's what the math works out to. So understand that. And then also, when stocks are falling, the rallies are more vicious, right? If you go back in history and you go to the biggest daily stock market moves of all time, up moves, positive moves, they all come in the midst of like the worst crashes, right? Because that's just the way the market is. The biggest, most vicious rallies are counter trend. So just being aware that those are the types of characteristics of this sort of market environment. That's just normal. So rather than being like, oh my God, I can't believe the Dow went up 600 points. We should expect those type of things, right? That's perfectly normal. So I think just being aware that we're in a different regime.
One way I would respond to your question is by citing the work some of you may know, John Ehlers, E-H-L-E-R-S, who has studied cycles in the market. And in fact, some of Brian's good work in the area of VWAP, I believe, taps into cycles in markets. And what John's work teaches us is that markets have trend elements, the directional linear element, and multiple cyclical elements. And our job is to figure out where's the dominant cycles, which cycles are most impacting price action here and now. And so I'm going to want to adjust my trading for those dominant cycles, because if we get a cycle low at a higher low point, I want to think about riding that, particularly in the direction of the market. So it's a way of adapting to markets by tracking the cycles over time.
I saw a question from Jane over there.
Yeah, you guys have massive amount of experience in the trading world. And what would you tell yourself as a beginning trader with all the knowledge that you have? What is the one crucial bit of information that you would share to yourself as a beginning trader?
You want to repeat the question?
So Jane asked, what is the one piece of advice, essentially what you asked is, what is the one piece of advice you would give to your yourself, if you can go back in time, when you were just beginning your trading journey, what's that one piece of advice you'd give yourself? Right? Is that right?
That you don't know anything.
Yeah.
And you're never going to know anything. So don't ever think that, We've all been there. We make a good trade, and then you start adding it up. You're like, man, if I do that every day, then I'll make this, and then I'll be like, oh, and then I'll make $100 million by the end of the year. We've all been there, right? And then we've all been on the downside, be like, oh my God, what a terrible day. If this happens every day, I'll be broke by next Tuesday, right? So I think the lesson is, you don't want to get too high. You don't want to get too low. If you think things are good, it's not as good as you think. Things are bad, it's not as bad as you think either, right? So you don't know anything. And so therefore, don't pretend you know anything and always visualize being wrong. Just assume you're wrong. Every single time you enter the trade, just assume you're wrong, calculate what those losses are, and ask yourself if you can live with that or not. And if you can, then when you're wrong, big freaking deal. You move on, there'll be another trade.
I would tell myself, fortunately for me, I've always been, it's come very naturally to me to sell a loser. I haven't been the type of person who stubbornly holds on. My biggest setback in my career has not been maximizing my gains. And I think that scaling out of a trade, partials on the way up, is something I've done to improve that over the years. Taking a third off, another third off, and just letting the final third go with a big wide stop and getting a windfall profit unexpectedly. So, hold the winners longer.
That's such an important point that Brian just made. What I've consistently found working with traders is that the position management is every bit as important as the entry or the idea behind the trade itself. How we put on the risk and scale in, scale out of the trade ends up having a huge impact on profitability. What I would tell myself, the advice that I've always given is to make sure that trading fits into your life, that your life is not trying to fit into trading, and that you always, 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 always have things in your life more important to you than trading and markets and P&L. Because then when you go through your losing periods, as we all do, you have those things to fall back upon. And it could be a wonderful wife like mine sitting in the back over there, kids, family, interests, friends, but always have something to keep yourself afloat when the profitability is not there.
That's great, Brett. Really good stuff there. I would say the advice I'd give to myself, I started trading in 1998, and I would say be more patient. I was in a hurry to be a millionaire in the first year, and I did everything I could to do that, and the end result was the complete opposite. Right? So I would say to myself, look, you could read all the trading books you want, and you could attend all the seminars you want, and you could hang out with all the smartest traders in the world, but you know what? Nothing is going to replace or be better than having experience, and that just takes time. And you got to just you got to have patience, and you have to be willing to put in the time and do the reps, and as JC says, do the work, because nothing will replace that. Nothing is better than that. It takes time.
Yeah. How do I know that the most vicious rallies happen in bear markets? Because I've been short through some of the most vicious rallies in bear markets. So I don't forget, So I could tell you, you could read a million books and people could tell you these things a million times, but until you're short and this sucker's gapping up 500 on you, you're never going to get it until that happens.
Do we have any questions from this side of the room? I've kind of been looking this way. I apologize if I missed anybody.
We feel so ignored right now.
Kunal.
We're underserved this time.
Any questions? You have a combined, I don't know, nearly 100 years of trading experience up here on this panel. Whether it's good or bad, I don't know, but we might be able to answer some questions.
It's not 100.
All right, JC's 23 years old. He wants you guys to think he's young.
He's not even close to 100.
If I could just make an observation before we take a question here. One common theme that I observed, and I think we referenced it, Kunal made the comments, and for both of you, that we learn through intensive repetition. That looking at things, studying things, living through things, doing again, nothing substitutes for ongoing intensive experience. And you can gain insights from books and from seminars and all that good stuff. But at the end of the day, it's what we internalize from our experience that brings expertise. I think you had a question, and then you, yeah.
Well, Scott, are we running out of time?
Well, no, there's a question from the chat.
Oh,
Mary Miller asks, question for panelists, what stock fundamentals do you check off in your mind before making a technical trade?
So the question is, what stock fundamentals do you check off before making a more technical trade?
Well, if it's a technical trade, it's based on technicals, basically. If it's something I want to hold a little bit longer, I think that the real fundamentals that matter are sales and earnings. Are they selling more stuff, and are they making more money selling that stuff, whatever the stuff is?
So I don't look at fundamentals. Like, I wouldn't even know where to start. I don't even know how it would help. But we do look at what the people looking at the fundamentals think, and we'll take the other side of that. So, like, for example, if a stock making new 52-week highs and only 10% of Wall Street analysts have a buy recommendation on it, we're going to buy it. You know what I mean? Like, I'll take that all day. Economists are terrible too, so we'll take the other side of what they think. If economists all think one thing, it's probably going to... And listen, I'm not hating. Warren Buffett, what did he say? If your company employs an economist, you have one employee too many? You know? That was Warren Buffett. That's not JC.
well, I can't possibly top that. So there was a question over here.
So you talked about, Dr. Brett, earlier about, well, you referenced thinking fast and slow and the difference between a fast thinker and a deep thinker. So how would somebody know, how do you know if you're a fast or a deep thinker? And as much as somebody may want to be a day trader chasing the open, they're just not wired to make that successful. Like, how do you figure that out?
It's a great question. How do you figure out your cognitive strengths? How do you figure out if you're a fast thinker or a slower, deeper thinker? The way to do that is to examine the successes in your life prior to your trading. What have you succeeded at? What have you done really well? Because anything you've done very well will have drawn upon your strengths. So for instance, there are some people, Mike, we know at SMB, there are some very successful traders. And what were they doing before they came to trading? Playing video games and doing very well playing video games because they were so fast in processing information, and they are very short-term traders. And there are others I've worked with at hedge funds that have done great research as analysts and have succeeded in generating ideas, and now they're managing money. But their success came from the deeper thinking. So we look to our histories to see what we've done well to tell us what our strengths have been.
Scott had a couple questions from the live stream.
A couple questions from the chat, so I'll start with one from Arturo. He says, say I'm starting with a 100K portfolio, how much do folks put on each trade max? In parentheses, per elder, you go something like 2.5% to 3%, in parentheses. Also, how much max percent do you allocate for a position?
So the question was for the live stream people who didn't hear, if you had a $100,000 account, what is an appropriate risk amount that you're willing to risk per trade? That's essentially what the question was. I'll start quickly. I mean, I don't think there's a right answer. There's a ballpark that I think we would all agree on, but you know, it kind of comes down to your own comfort level. But I think a good rule of thumb for most traders is anything more than say 2%, and that might even be too much, is pretty aggressive to be risking for your portfolio. I mean, I know very successful traders like Peter Brandt, commodities trader. He doesn't risk more than 25 basis points on any one trade he gets into, and it served him well over a 40-year career.
Yeah, go ahead.
Yeah, I think Peter Brandt's a great example. You know, if you place lots of trades that follow lots of markets or lots of stocks, and you're risking a limited amount, but each of your ideas has a positive expected return, you can have a pretty smooth equity curve. And that's good on the psyche, and it's good for the account. So diversifying risk-taking and placing smaller bets per trade across independent trades is what we see in the professional trading community.
I love the phrase. I forget who I heard it from. It might come to me by the end of this, but like it or not, when you put your money in the market, you commit your emotions as well. And when you leverage those with bigger stops or with triple ETFs or with options, your emotions are magnified as well. And you want to keep your risk to as little as possible, and it's all kinds of personal parameters in there, and what the intended time frame for the trade was as well.
I think we had a question over there.
Yeah, if you're losing sleep at night, you're too big, right? So to me, figure out how much you want to lose and what you're comfortable with on a dollar basis. And then, one mistake I see all the time is people putting arbitrary stop losses. It's like, I'm going to put a stop 5% below my entry. Like, why? Why 5? Why not 4.9, right? Or 10%, or arbitrary trailing stops also, right? Just at arbitrary levels. So to me, you figure out where your stop is based on price, right? Like where you are, your thesis is no longer valid. And then figure out where your entry point is. And figure out, is that let's say it's $1 away. Then take how much money you're willing to lose, divided by that $1 per share, and that's how many shares you should buy. That's how I look at it. And then make sure that the potential reward is always exponentially greater than that risk, which is where Dr. S was talking about that positive equity curve. You get 3 or 4 trades wrong, you get one that makes up for it and then some.
That's what you want.
I don't know if I'm allowed to say this, but Dan Merkin was telling me earlier that they have a new feature in Trade Ideas where you can just set, my risk is $500, and it'll automatically size that trade for you based on where you have your stop, which is just a great way to really make it honed in on here's what my risk is on an absolute basis.
That's a great plug for our Brokerage Plus feature. Go ahead.
Yeah, I just kind of had something to kind of interject into this, but when I first started trading, I had called my brokerage. I was like a revenge trader. I found out that was my pattern. I was a revenge trader, and so I would get into trading, and then I would lose, and I would try to add more, and I kept adding more into my losses, and so I'd end up smoking my account out. But I've been with Speed Trader, and they have an option with them to where you can put a cap on it. So once you get over a certain loss, so my number was $1,000. So once I got to a daily $1,000 loss, it just locked my account. I couldn't do any more trading, and that was really, really beneficial on my early days. But the numbers obviously can change on how much you want to risk. 500, 1,000, 2,000, whatever your account size is. But that was really helpful for me on my early days.
Yeah,
for trading.
That's a great point. If I could respond to that. So the question is about revenge trading and ending up having losses magnified. And so your account now locks you out basically if you hit a certain loss limit. And in fact, at many professional trading firms, there are those kind of loss limits. Mike, you know about this, daily loss limits. Each trader has a limit. The reason for that, and the way I frame it is, most pitchers will not take themselves off the mound themselves. What has to happen? If the pitcher's not pitching well, what has to happen? Coach comes out to the mound and says, buddy, you'll do better next time. But no pitcher having a competitive spirit is going to take themselves off the mound. And so sometimes we need those risk limits and the stop outs on the day or on the week or on the month to take us off the mound, let us regroup, and come back fresh.
Right. Okay, David, you can finally ask your question now.
Okay. Self-serving, because this also is a preview to the next panel, but we've talked about all the things that we can do, the variables we can control, the decisions we need to make, and how our inputs can be better. If we increase the quality of our inputs, we can have a better output. I'd like to hear from the panel, what are the obstacles, the games that Wall Street, the markets play? We've talked about some of it, but when an analyst comes out with a rating or so, sometimes it's just sometimes it's just to sell a stock they got to get through. So they'll put on a buy rating, or some of the pre-market issues that we've talked about. If you could identify what's the sharpest game or impediment to a better market, and then if you could also suggest what you would like to see.
So the question is, what is your biggest impediment in the market, and how do you overcome that? Why don't we start with Brian on this one?
Thanks a lot.
just threw that bomb in your direction.
Something that I see a lot, and I think a lot of people are prone to, is just chasing a move. So what I like to always do and encourage other people to do is slow down and say, where has it come from? Where does it have the potential to go? Has it expended a lot of energy? Is it at a level of interest that might become resistance? And if you're chasing breakouts, I think a lot of people, common trap for new traders, buy breakouts to a 50-new week high. Good idea sometimes, but if it's up 10% the 3 days before that, it's almost guaranteed to get sold into. So where has it come from, and how much more do you realistically expect? There's always that stock that will go 50%, and you can point to that, but what's realistic and what do the odds suggest?
Yeah, I just realized we threw this question at a panel of traders who are mostly technical. So they couldn't care less about the analyst upgrade and things.
But the analyst upgrade, I think is relevant, and again, this is something that I know with the developing traders, Mike and I have talked about, and that is, think about the big institutional desks, the equity desks. How are they executing their trades? Is the portfolio manager, give you an example, the smallest portfolio size at the firm that brought me to Connecticut is $200 million. That's the smallest, and there are plenty that are a yard or more. Now, if an analyst upgrade comes out and they decide that that's meaningful, how are they going to execute that trade? How are they going to buy that stock? Short version. No, they wouldn't do that. But they can't do it all at once. They have too much size. And so they have execution desks that have to place those orders over time. And they will do that at the most liquid points of the day, which tend to be the early morning hours. That's why Kunal's point was so good about different setups work at different times of day. That's because the big execution desks are active and less active at certain points of day. So if you have news that comes out from an analyst upgrade and you don't see meaningful buying at the time that the institutional desks are most active, that news is not news. On the other hand, if you see a meaningful gap and go, then that's telling you that the institutions are acting on that. So we can adapt to the games that are played by understanding the participants and how they behave.
Scott, was there another question from the live stream?
Yeah, there's several. At least one. How can you learn the reversal strategy considering we are also told that the trend is your friend?
Question was, how can we learn a reversal strategy but when we're also being told that the trend is our friend?
Well, the reason the trend is your friend with benefits is because if you just look at a chart, it goes up for a while, it goes down for a while, like markets trend by nature. That's just the way that the market behaves. So, but at the same time, there's up cycles and down cycles. So the idea is to identify what are those sorts of characteristics that would appear if that trend is no longer in place. Getting back to visualizing in the future, what it is. And, like I was always like a shortstop, second baseman, so I was always very vocal on the infield. Guys, there's 2 outs. So, hey, there's 1 out, man on first, returning 2, like you're always communicating. And I was always that guy. So like in the market, it's the same thing. Like, okay, so you have to know where you're going to go with the ball. If you're a shortstop and there's a man on first, you're going to go and turn 2 with the second baseman. But before the ball is hit to you, you have to determine what you're going to do if the ball is hit to you. Oh, is there a play at the plate, right? Are we turning 2? There's nobody on. We're going to have to go to first base. It's the same thing in the market, right? What are you going to do if these things happen? Like if you think the banks are going to go up and now all of a sudden banks are getting slaughtered, I think it's visualizing it ahead of time.
I think it's like Brett said, it's finding that market information. If your original thesis is rejected and you're getting some kind of technical feedback from the market, even as simple as I'll be the one-string banjo of a volume-weighted average price. If the stock gaps up and it just stays below that for that day, and we can use a short-term time frame and extrapolate that to longer term, then it's telling you, the market information is telling you, money's flowing out of this. This is being sold into. Learn to listen to the message of the market. If it gaps up, holds below VWAP for 10, 15 minutes, or breaks the opening range or the volume-weighted average price, then you say to yourself, what's my risk? Is my risk worth the potential reward? And decide to get involved, or just, if you're really uncertain, then just leave it the heck alone.
I think we had a question over here, unless Brett, you wanted to add something.
I'll just add something really quickly, and then we'll get your question over here. V tops and V bottoms are the exception. That typically there's some rolling over on both sides, and we can see when a trend is weakening, and that can alert us to possible reversal opportunities. If you go back to my blog, I think it was September 24th, I wrote about how there were yellow caution signals in the market. And I wrote that because a measure called the NYSE tick, it's $ tick on most platforms, was consistently producing negative numbers even on up days. More stocks were trading on down ticks than up ticks. And historically, that has happened when trends have been long in the tooth. And so it gave us a nice alert that this trend, which we were seeing in the S&P, is starting to break down with the small caps, break down with some of the sectors like housing, like financials. And sure enough, we ended up coming down. So there's a place for seeing where things are strengthening, weakening, and trend, but also where we're making turning points. And you had a question.
Yeah, as somebody who's personally seen time and time again that people who are highly intelligent somehow just can't grasp trading, they lack the emotional stability. How much percent do you feel of trading, trading to technical skills ratio-wise, do you feel like the psychological aspect of it weighs on the trading as well?
How important is the psychological aspect of trading?
I know it's a little bit arbitrary, but if you were to put a number, like a ratio to it, what do you think?
Given that intelligent people sometimes are not successful traders, to what degree is psychology relevant? Do you guys want to tackle that? I'll respond in due time.
Yeah, I don't think that you need to be like the smartest person in the world. I think it's, what's the book? Adam Gladwell. What's the name of the book? Outliers.
Outliers, yeah.
You only have to be smart enough, right? Like you can't have a 90 IQ, but like 100 plus. Like, you just have to be smart enough. You don't have to be the smartest guy in the world. I think the example that he said was like to play basketball. Like, listen, if you're 4 feet tall, you have no chance, right? But you have to be like 6 feet tall-ish at least, right? So you have to be tall enough because there's a law of diminishing returns. Once you start getting 8 feet tall, like being tall helps in basketball, but you need other skills as well. Being tall alone is not enough. Being smart is not enough. There are other tools that you need. So you don't have to be like a super genius. I mean, like,
right.
Look at us.
Well, I mean, hey. Well, hey, PhDs found a way to lose, what, $1 trillion of long-term capital management. So, I mean, and I spent a lot of time in Chicago and worked at the Chicago Board of Trade. And believe me, I met a lot of dumb rich guys who traded on the floor. So they would never confuse you of being, being a smart, educated person, but they were killers in the pits, and they made tons of money.
And the reality, what the research tells us in psychology, is that there are multiple intelligences. There are multiple ways in which people are intelligent. And so we tend to identify intelligence with book smarts. And we know that that's not correlated with performance skill in most domains. But there are skills that are intelligence that are not book smarts. For instance, the poker player who can look around the table and pick up tells from the other players and read what's probably in their hands and how they're going to behave. That's a huge form of intelligence, and I believe it's relevant to trading, but it wouldn't be the book smarts. So it's not necessarily that the quote-unquote intelligent person has deficits psychologically. It may be that they just have the wrong type of intelligence for that type of market activity.
Okay, we have a question here from Clayton.
Segue, from that question, the emotional management, what are some techniques that you've talked about visualization a lot? I found that meditation helps me tremendously. Other things that you personally use or think are helpful?
Craft beer.
So the question from Clayton was, what are some things you do to kind of get your head right so that you're in the right space to trade effectively and profitably?
I live in Colorado.
Don't say any more, Brian. Don't say any more.
I think just a healthy lifestyle. Work out, feel good about yourself, healthy mind.
Yeah, Dr. Brett was saying before, make sure that trading is not the most important thing in your life. Have other things, whether it's your family or, Dolphins, Miami Dolphins. Thank God the futures open on Sunday nights. It makes me feel better after the Dolphins lose. I use the market to help me with my football problems. See? I like learning about other things, So, instead of reading another freaking trading book, I've read a zillion of them, behavioral finance, another zillion of those. I read about wine. I study wine. Like, I do that for fun. Other people do other things. I like learning.
I too engage in meditation, and that's something that I do pretty much every day before the markets open. So that helps me. I'm also working on this. I'm not as good at this as I'd like to be, but I'm trying to bring gratitude into what I do. And I know it sounds cheesy, but I like to have gratitude for the opportunities that I have to participate in the market, and it kind of puts me in the right frame of mind that like nothing's given to me, but I have a great opportunity before me. It's a new day. There's new opportunities, and I'm going to try to capitalize them. I try to do that. I'm not great at that, but it's something I'm working on.
What the research tells us, and I covered this some in a book I wrote, is that maximizing our positive emotional experience helps us weather the storms emotionally when things go wrong. There are 4 big domains of positive emotional experiencing. The first is happiness, doing things that are fun. The second is fulfillment, doing things that are meaningful. The third area is energy, doing things that stimulate us. It could be intellectual stimulation. It could be physical exercise, stimulating the body. And the fourth area is relationships, deepening our attachments to the people who matter to us. And so with the portfolio managers I work with, we actually take their weekly schedules and make sure that they're firing on all 4 of those cylinders. Are you doing things in your life that are fun? Are you doing things in your life that are meaningful? Are you doing things in your life that give you energy? Are you doing things in your life that bring you close to the people who matter? And if you're doing all those things, stuff can go wrong in markets, but you're much less likely to have the stress become distress.
Right. Well, we are running up against our time here. You guys want to have a final word each? You feel like you got something you got to say? Brian, you look like you got something you want to say.
Actually, I was thinking, why am I holding the microphone again? No, I really don't. I mean, this has been a great event, and I think that, pick up a couple nuggets wherever they come from and, develop your own process. Make it yours. Don't just follow people into trades. As I said earlier, I never try to tell someone what to do. I present facts and say, make it yours now. It's your money. You should care about it more than anyone else does. Don't look for someone to tell you what to do.
Yep. I'll just finish off by saying that, we're all experienced traders up here, but we are by no means the experts, okay? Everyone in here who's engaging in the markets, you're an expert in some way, okay? So what we're trying to do here with the events like this, we're trying to build a community here, right? I mean, we're all traders. We're all in this together. Yes, we're competing, so technically, but we're all in this together, and these guys are going to be around for the rest of the day. Happy hour later, network with people, get to know the other traders around you, and ask questions because we can all benefit. And it doesn't matter if you're an experienced trader who's been trading for 30 years or if you just started last week. Everybody has a perspective that somebody else can gain a benefit from. So, please share. And thanks for listening to us. And we'll pass the baton to Speed Trader and David Afaria.